Hey everybody, this is Jose. We are about to get started. Let's have a quick sound check, if that's okay. Just a quick message on the chat box so I know that you hear me well and that sound is good so we can start on time. Let's do this when you have a moment so we can begin. Thank you so much. Very good. Perfect. Thank you so much, Joe. Wonderful, everyone. Good to see you all. The timer is 0, so it's time to get started. Welcome to the session, everybody. This is Jose Blasco. Today is July 14, 2022, and this is our options session for us to look at the markets live, learn about trading options, find opportunities, manage trades that we may have identified in prior sessions that we executed. All of this and all of the above. How are you, Jeff? Mark, how are you? I guess you are like me. You just come out of the crypto course to get into the options room. Isn't it? Wonderful, wonderful, wonderful. Perfect. Okay, so hey, financial disclaimer, upper left side of the screen. Please read it carefully. This is important information. We always display our disclaimer. It's fairly short, so we're counting on you to read it completely. It is important information, and that's why. The session for today, again, for the ones of you that are new to the sessions, the format is kind of like this. We look at the market, we discuss what's happening out there, we look at the trades that we have running, we talk about them, we may act on them by doing some trade management, some tweaks, as I like to call it. And from there, we get into looking for new opportunities in the market. If available and meeting our rules, then we get to execute them. Okay, and today we have some work to do, actually. Okay, so I'm going to take a sip of water and we begin. So let's begin. Very nice, everybody. So the questions page. Here's the link, tradewithufos.com/Jose. That would be the questions page. You just come to the page, you scroll down all the way to the bottom, and this is where you find the answers, okay? You guys mentioned, to be specific, Joe, and you are with us today, that you had a problem with this page. Not sure what is it that happened, but we did notify this to the web department, if you wish, and they've done some resets and some things. So it should work, I would say. In any case, worst case, you can always shoot an email, and that's what you did, Joe. Well done. Anyway, so with the question page out of the way, we are now ready to move into the real-time charts so we can begin our real-time analysis of the markets. So first things first, let's look at the VIX. Mr. VIX, what's happening? We are trading at 28 VIX, which is not too low, not too high. Last week when we met, we talked about how the VIX was quite low, and that's why I was keen to look at a double calendar spread with Twitter, which we're going to review later, and you'll see it's been fun. And good news, volatility has been going up, and therefore this is indeed helping the trades where we are long Vega. Okay, so now is it too high? No. Is it too low? No. So what can we do here? Well, it will depend on the market conditions of the S&P, on what we conclude the S&P is doing, for us to get into certain trades that may be directional in the form of debit or credit, or maybe non-directional again in the form of debit or credit. We'll talk about this in a moment, because so far we have a partial understanding of the market conditions. Okay, we just know that from an implied volatility point of view, across the board, by looking at the VIX, options don't seem to be too expensive, don't seem to be too cheap. So I would say that anything makes sense. So now, of course, what will make sense the most is when we do our analysis of the S&P. So now we know better what to do given the current market condition. Okay, so what's going on with the S&P? Well, first, I would like to point at what we had last week as we were doing the session together. We were looking at non-confirmed climates with the blue line above the gray. The blue line, for the ones of you new to the sessions, the blue line represents the implied volatility of calls, where the gray line represents the implied volatility of puts. And we got the calls winning the battle against the puts, meaning that there were buyers coming into the market, and the climate was changing from red to blue, So that was exciting, but the message was very clear, isn't it? If you recall, the message was, it's exciting, but let's be careful, because what we need here is that we need a thick dot. Okay. And that thick dot, okay, something like that, okay, never happened. Okay. It never happened. It was all a collection of thin dots. And no wonder how the market never went anywhere, but then it started falling again. And now we are back to a condition where the market is confirmed as a down climate. So down climate, market moving down, confirm, but we can see how currently the buyers are winning the battle. So again, it's like the reverse picture that we had the other week. I mean, not exactly reverse, but kind of like the same conclusion, which is like, in this case, we have a directional condition which is confirmed. Last week, the directional condition was not confirmed. But then last week, we got buyers confirmed in a blue climate, where this week we got buyers confirmed in a red climate. So again, we got a contradiction in both cases, and therefore, one more time, non-directional trading, it's the safest bet, unless you have a portfolio where you have certain positions. And again, let's say some of your positions were short and you just hit targets, and now you are too long and you want to add some shorts as a hedge. And again, so then of course you have to do that. You have to enter those directional trades. But let's say you have nothing in the portfolio, or your portfolio is well balanced, and therefore, in order to add something else, you can afford to be picky. Well, a picky approach, at least the way I think of trading, the way my trading plan works, a picky approach would be to look for non-directional trades, because my climate condition is not agreeing with the volatility conditions, in this case, implied volatility conditions, and therefore the buyers and the sellers that are being revealed as we look at options data contradicts what the climate is saying, giving us basically the conclusion that this climate probably is not going to progress or go anywhere in a way that is significant enough. So that's what we have. Okay, that's what we have, and therefore you're going to see me look at non-directional opportunities in a moment. Now, of course, depending on what we find, because here's the issue: because the VIX is more or less in the middle, may not be too easy to find implied volatility high conditions to do iron condors, which is non-directional selling premium. Because the VIX is more or less in the middle, it may not be too easy either to find low conditions for implied volatility and therefore do double calendars. So depending on where we find the opportunities, then I'll then be happy to either focus on iron condors or focus on double diagonals. I would say it's kind of the same. Why? Because the VIX is in the middle, and therefore, I don't have a preference. So we'll look at that later when I look at the VIX at the matrix. Okay. One last comment I would like to make, which again is kind of like I don't know how to call it, Murphy's Law maybe, is that when we look at the real-time implied volatility, so you can see how the blue line and the gray line are exactly in the same place. So today, as we're having a candlestick which shows pretty much as a classical, it's a little bit of a hammer type of candlestick, a little bit, but it's also a little bit of a doji type of candlestick. I mean, the market is not closed yet either, so the candle doesn't mean anything yet. But you can see a little bit of indecision with prices going up and down in a daily basis, and this is being translated precisely, perfectly, based on the implied volatilities of the calls and the puts to be equal. So, if I had a little bit more calls and puts here as a 3-day average on the left, but then here I got clearly the gray line above the blue. So then I could say, look, sellers are coming in. Okay, let's get directional short. You could be a little bit of a, more, if you wish, daring, if I could use that term, and do that. But we don't have that. It's equality intraday. And as an average, the call side is winning against the put side. So there are some buyers somewhere. Again, the climate being down, it's too early to say. But there are some buyers somewhere still in the market. We can see that from the options data. Okay, so we gotta play patience, and in a way, a smart way, safe way to play patience is to do non-directional trading. Okay, so that's gonna be my approach in a moment. Everybody, please give me some confirmation, some feedback. Is everybody with me? any different view, any opinion, any concern, go ahead and type it in because I am about to review the trades and get into new opportunities. Mark is with me. Thank you so much. Jeff is with me. Thank you so much. Perfect. Okay, so the trades. We got 3 trades to review. One is Verizon, the second one is Delta Airlines, and the third one is Twitter. Okay, those are the 3 trades we need to review. So with Verizon, I'm just going to keep it very short. This trade expires, and it expires. Look at here, right here, Verizon. It expires on July 15, which is tomorrow, right? So this week, this trade will be gone. And this trade is a trade where, we entered at this moment in time. That stock went all the way against us, right? So we entered around, we entered around 49. The stock is trading around 50. So actually, overall, it went a little higher. Anyway, roller coaster here, up and down very aggressively all the time. Good news. With the trade management that we did, we made sure this trade could not lose. And this was a trade where no matter where we end up, the minimum we're going to make is $36. And if we were to go above 55, which is, I would say, not going to happen because it expires tomorrow, then we would have made, I believe, was close to 300. I am not going to review the risk graph just to save a little bit of time because we've done that multiple weeks. The trade expires tomorrow. Again, the net P&L of the trade will be $36 per contract. It's not too much, but given the fact that this trade went nowhere, I would say congratulations, job well done. Delta Airlines is the next one I want to review, and this one I want to comment on a couple of interesting things. So first of all, I will comment on the first interesting thing very quick because it's nothing new. We commented on it in prior weeks. So we entered that stock. It was a non-directional trade. The stock went like crazy, moving against us like at the speed of the light, and then stayed crushed. Normally, when you have such a strong move, very often you get a bounce. This would have helped the trade to potentially become profitable at some point, but it never had a bounce. It stayed dead down here. So that never helped the trade. But then, actually, let me bring the risk graph for this one. Then we kept massaging the trade until last week, where we converted this double calendar risk graph. We converted this double calendar into a double diagonal. And this puts us in a position where now, worst case, we were going to lose 146. That's the worst case. Best case, we would lose 46 only. Okay? Which is what looks like is going to happen because the current price of the stock is 29 something. So, the current P&L is negative 47. So this trade would end up at that level. Okay? Now, this is not exactly true. Why? Because, number one, the call side that we kept attempting to sell at 15 cents, we never got filled on this one. So therefore, those 15 cents were never collected. So therefore, the P&L is actually a little worse than that. Okay? So the P&L would be equivalent. Let me get a calculator. So on the call side, okay, so we own the 43 call, we pay 127, and then the 44 call, we've been collecting all the way to 37 cents, but we got 15 cents built in there that we never collected. So the reality is we only collected 22, not 37. And on top of that, we were never able to sell the 44 call, so we don't even have it. So one way for me to simulate that is that instead of 127, I paid 105, and I don't have the 44 call. And if I do that, the risk graph is going to be different. But basically, my worst case scenario would be to lose a bit more than 46. Okay, if I put my mouse here, so you will see now that the blue line here is 61. Okay, which is 46 plus those $15 of extra pain because I never got those $15. So worst case is actually losing 61, not 46. 46 would have implied that we got filled on the 44 call, which we never did. Is trading at 1 cent. It's not going to happen. Okay, so this will expire tomorrow because 15th of July is tomorrow. So the real ending story for this trade will be to lose $61 per contract, which, to be honest, is a fantastic end of the story, given the fact that the stock went against us all the way, all the way, all the way, and instead of like a $200+ risk that we had in the beginning, so we end up leaving this trade for $61 of loss per contract. So it's a brilliant management. I mean, a bad trade because it went against us, but a brilliant effect of the massaging that we do, and a great way to manage our risk and improves our returns to risk ratios and everything else by taking a larger potential loss into a much tinier one. So I'm very happy to see this, in the sense that it's a great example of things that you should be doing on your own. While we are not meeting every day, I'm sure you're looking at the markets, maybe not every day, but in a regular basis, I would say. And when you are identifying your opportunities, if you treat them this way, if you manage the trades this way, so you could end up with these particular outcomes. And if you have never seen that before, well, I'm glad to be able to display this on the screen, so you understand the power of trade management. Okay? Cool. Now, having said that, on top of all of this, again, I have nothing else to add to Delta Airlines. That's going to be the end of the story. We're losing 61 per contract, end of the story. But at the same time, there is one more thing I want to share about Delta Airlines, not about Delta Airlines, but about the fact that sometimes when you execute trades in a simulated account, weird things happen. So something very weird happened to me on the Thinkorswim demo account. Not the first time, by the way. Okay, take a look at what happened to my Delta Airlines. Okay, it shows a negative P&L of negative 782. You're gonna be like, what? How can that be? Well, that's exactly what I thought. And when you look at it, notice what just happened. In this account, okay, I am long 200 shares of Delta. How did that happen? I was only short one put, which by the way was the 35, and it was only one. So how come I got assigned 200 shares if I was only short one put? And on top of that, it was the 35. How come I got a trade price of being assigned at 35.5 instead of 35? So Thinkorswim got cuckoo, which happens. And based on what I see on the screen, and I've seen that happen before, so what happened is that when I did the roll, while the roll happened, and we saw it on the screen last week, I mean, we were together if you were with me in the session, I guess in the background, in the paper trading servers of Thinkorswim, the trade was not properly registered, and basically the system assumed I got two trades in the system. One, where I was short the 35 put expiring on July 15, and one where I was short the 36 put expiring the prior week. So the roll was not completed on the simulation servers, which these are things that could happen and do happen. And it's one of those weird situations which I love to show when something weird happens, because I remember when I was learning how to trade by myself and something weird would happen. Sometimes, I would really need to scratch my head and try to understand what happened. And sometimes I would not have an answer, and I would need to spend hours with the chat rooms, hours with the technical departments of broker ABC to try to find out what happened. And so I love it when these things happen, so I can show you and explain what is it that happened. So now you know, and you don't need to scratch your head or spend too much time, and also, most importantly, not to hurt your confidence level if something like that happens and you're like, oh my God, is that going to happen in a real account for me? Well, no. This could not have happened in a real account because we were short the 35 put. We were not short the 35 and the 36, and therefore is no way we can get assigned, and even less for 35.5. Okay? So things that happen in the world of demo trading or paper trading, and again, those are tools that you will very likely use for your practice and development. And when these things happen, it may put you in that situation. So anyway, everybody could please confirm that you got me, you understand what happened, the weirdness that we just saw together, you understand what is it coming from, and it's all clear. If it's not, let me know and I will explain it. And as you answer my question here, I am now moving into Twitter so we can do our market review for Twitter and go for the next trade. All good, understand. Very nice. I love it, guys. Okay, when these things happen, I really like it. That's why many times you see me pushing some trades with market orders and things like that. I really want those fields to take place because there is so much more stuff that we can talk about. In this case, is a demo account, which is not even real trading, but it's a very important tool for your practice and development, isn't it? When you are simulating maybe a new strategy that you are working on or something like that, you back test, then you forward test. Well, when you forward test, you are using a demo account in most cases, isn't it? So yeah, again, good stuff. Twitter, oh my god, right? Did not get filled on Twitter either time. Okay, well, so then you never got to see what happened in your account, but you will see it in mine. And I just gave it a title, and the title was "Oh my God." I mean, I really, I say "Oh my God" because of two reasons. First of all, because of the price action. Okay, crazy move to the downside, followed by a crazy bounce. Well, these crazy bounce never happen on Delta Airlines, but typically that's what happens when a crazy move happens in one direction. Often, it's followed by a crazy move in the opposite direction. So I'm not surprised of this. But I guess it's fair enough to call it "Oh my God." Why? Because it's a pretty powerful stuff, pretty powerful move. Now, the other reason why I was saying "Oh my God" is really because of what's behind this. Okay, I'm probably not that I am into news, but again, just to have fun a little bit here. Um, Probably you have heard about the deal between Elon Musk and Twitter, where Elon Musk was going to buy this company, and they had a very big multiple $1 billion deal, uh, and then Elon Musk decided to not to buy for certain reasons that were not part of the contract, stepped away from the deal, and next thing you know, Twitter said that they're going to sue Elon Musk, and it seems that they have a real case in front of them because getting out of the deal was not in line with what was on the initial agreement. So interesting. I mean, it's in the world of business, ethics, and I would say, not sure if the right term is to talk about business etiquette or being a gentleman, or maybe just simply say keep your word or something like that. But certainly this business practice doesn't seem to be too legit, and quite disappointing of such a person. So I'm very interested to see what's going to happen in the court in this case, out of curiosity. Okay, but in any case, the stock, going back to the trades, reacted in such a violent way, which is great. Okay, which is great because this is often the recipe for implied volatility to go higher. Okay, and you can see since we entered this trade on that particular date, volatility went higher and then went lower a little bit. But again, this is when you see the implied volatility in the indicator. Of course, is utilizing at the money options, is utilizing a weighted calculation based on deltas. There is a collection of things, but then when it comes to individual units, which are the units that we have in the trade, those units often act in a way that is totally different. Okay, and when there is a big move like that is happening because of such a condition, such as a news like this, normally doing the role that we normally do can be done in a very powerful manner. So I'm not sure what is it that we're going to find today, but certainly if you try the role the day before or 2 days ago when all this craziness was happening, often you would find very massive price anomalies in certain strikes. And it happened to me many times where you do a roll and basically now the trade becomes risk-free. And it's just 1 week. 1 week into the trade, you do the roll and the trade is risk-free because all of these anomalies of price create such a spike on implied volatility in certain strikes, and you can really do something very cool. So today we'll see what is it that we're going to find. Okay, I'm very curious to see it and do it with you. But again, worst case, this trade is just gonna experience I would say a proper roll. That would be my expectation. That would be the worst case scenario. Okay, so where are we at? We are here. Okay, we are here. Okay, the stock moved from where we want it to be, so therefore it's showing a little bit underwater. The maximum risk for this trade is 198. Okay, we pay 198, so the most you can lose is 198. And now we are about to prepare and do a roll. Okay, now for us to do the roll on these trades, we need to make sure that we do it only when we got distorted Greeks. So if we look at Twitter, okay, and by the way, the strikes we're using are 42 and 37. Okay, so we are looking at 42 and 37. Okay, so 32, 37, 42, 37, I meant to say, and we are looking at July 15 and July 22nd. So if we start with the call side, okay, and we look at the bid and the ask is 1 to 2 cents, and the theta, it's not even calculated, so I guess it's easy to say it's distorted. So let's move it to the next expiration date, which is right here. So hopefully we can get our 15 cents for the roll. So I guess that the 42 call is a no-brainer. Let's roll it. Okay, so Twitter, call side, right here, create a rolling order from July 15 to July 22nd, 42 strike. It seems that we can do it at 11. So I would like to do this at 15. Okay, so I'm going to try 15 and see what happens. And if not, again, I'm going to push it because, again, I want to have it in the system so I can review this in future sessions. But again, with patience, and what I said earlier is that, again, if you had done it maybe the day before, something like that, because this thing has been crushed already, right? The stock went down. We are very close to expiration. So 1 to 2 cents is not going to give you too much. But in the prior days, you may have been able to sell it for a little more. And therefore, the total net value for the roll would be 15 or something like that, which is what we want in a perfect world, okay? So I'm pretty positive that would have been the case, okay? But anyway, I'm still going to be okay with 11 cents. So worst case, I'm going to get my market order in, okay? Now, on the put side, what do we have? So we have the 37 put, which is currently trading between 80 and 76. Okay, so let's call it 78. And if we look at the theta for the put, so the theta is talking about 23 cents. Okay, so 23 cents times 2 days, okay, that's 46 cents. Okay, 46 cents is less than 80. So the Greeks are not distorted yet on that option. And why is it? Is because it's basically the at the money strike. And the at the money strike, or close to the at the money strike in this case, it's going to be the strike that takes the greatest amount of time to get distorted Greeks. Why? Because being the at the money, it's the closest to reality. So therefore, it's the furthest away from distortion. Then patience should apply, and we should not do the roll until we see a distortion. And again, a distortion would be that the theta value, okay, let's say the theta value was, let's say 0.44. So if it's 0.44 times 2 days, it would be 0.88. And 0.88 is certainly more than 0.79. And therefore, you would say, hey, theta is suggesting more decay than what the decay is available, which is 79. So the Greeks are distorted. So let's roll. Okay, so we don't have distorted Greeks, but in any case, I'm gonna roll anyway. Okay, I'm gonna roll anyway because I'm not gonna be here tomorrow, right? And then if I don't do it today, so then I cannot do it because we don't have a session tomorrow. So I'm gonna do it. But and again, if you were to do it today, you are leaving very few cents on the table, and it's not a big deal. Again, if you are an active trader, if you spend time in front of the markets in a daily basis, so then I would say, just apply a little bit of patience and do it only when the Greeks are distorted, okay? Which is the rule that we use. In my case, I'm just going to go for it now. We're going to use the 37 put. We're going to create a rolling order. And we can get 82 cents for that. That's great because that's going to reduce the risk of the trade by 82. And therefore, our $200 trade will become, $100+ risk instead of 200. Okay, so we have the order there in the system, 82. Okay, the last traded price was 82.5. So maybe I should try to get a little less. Okay, let me try to get 81 or 80 and see if I get that. Okay, I got filled at 80. Okay, so I got filled at 80, and since I am in the process of getting the fills, so let me push the call side with a market order, so I get it out of the way, so I can document the whole thing, and then we can get into new trades. So I got filled at 10 cents. Okay, so that's not ideal. Again, with patience, I'm pretty positive you can get a bit more, especially if you did it in the prior days, based on what I said about those price anomalies and so on. But that's what I got today. Okay, so now let's document all of this. So I got this trade, okay, the same trade, but now instead of July 15 and July 15, so I got July 22nd and July 22nd. For the call side, I got 10 cents. So instead of 29, it's equivalent to I got 39. And on the put side, I got 80 cents. So that would be equivalent to, instead of 0.47, so that would be 1.27. Okay, 80 cents more. Okay, so if I click OK, so what's happening now? Well, I end up with a different risk profile, which is very similar to the one I had. But the beauty now is that, worst case, my risk is going to be the orange line instead of the blue line. And therefore, my risk now is 108 instead of 198. So I cut the risk into half. Even though Twitter moved a lot against me, I've already cut the risk into half. Okay? So again, happy to do it again next week. So next week, the final expression that is July 29. So we're going to be able to do something about it again next week. And hopefully, earnings that are approaching. I just made a mistake here. I just closed the whole thing without copying. Let me do it again. Sorry for that. I went too fast. So we said 22.22, and we said 39 and 127. Here we go. So let me copy this so I can put it here. So this is the new trade we have. Okay. And earnings are supposed to happen on 728. So again, when we do the roll next week, those 729 options should be trading at a higher level of implied volatility. We should see a movement to the upside on the implied volatility. And this should benefit us greatly to do another very powerful roll next week that may put us in a sure thing profit or close to that. That's the goal, and therefore the trade is evolving correctly so far. What we've done today is to take that July 15 to become July 22nd on the put side, and same on the call side. That's what we've done. Okay, so cool. That's it. I'm done with review and everything else, and now it's time to get going planning for new trades. Okay, so take a look at the S&P. What's happening? About the same. Very similar to what we discussed. What I don't like about the Twitter is that we were actually making money from the spammers. I'm not sure what you mean by that, Mark. You mean spammers, like people that are just like, posting, stuff on Twitter with bots and things like that, or you are referring to some sort of a trading concept with spammers? Let me know about that. I guess that you are just thinking about Twitter as a social media tool. But by the way, those spammers are in Instagram and Facebook and LinkedIn and Twitch and everything else, and TikTok and YouTube, and so they are everywhere anyway, right? So it's the same thing. It's not like there's only bots in Twitter; they are everywhere. Anyway, so let's continue. Yeah, well, like Musk didn't know. that to me is a very, again, I don't know what I don't know, but it sounds extremely funny. So let's go for it. We're gonna activate the matrix, okay? And again, we are looking for non-directional trades, okay? So let me go ahead and use all stock symbols on the top. And for non-directional trades, what I want to make sure is that I have my list in place, penny increment options, and I want to make sure I got nothing on auto climate because I am being non-directional, so that check mark is on check. Earnings, I want to exclude anything that report earnings in 15 days or less. And then most importantly, from a neutrality point of view, I want daily timeframes to show neutral price action, weekly timeframes to show neutral price action. If I scan, I'm going to get very few. And of course, now if on top of those very few, I add that I want my options to either be very expensive or very cheap. Okay, let's begin with very expensive. So CIV mean greater than 80, I may get nothing. Exactly. If I move into implied volatility greater than 2 standard deviations, I got 2. Okay, so we got a basis to at least look for iron condors. Okay, great. Basically, this is how I'm going to set my preference to either go for iron condors or double calendars. Because if I look for double calendars, maybe I got nothing. If I look for iron condors, maybe I got nothing. Given the fact that the amount of symbols we're going to get is very little. Why? Because the market is violent. So with a violent market, you're going to find few neutrality opportunities. And on top of that, the VIX is in the middle. So with the VIX being in the middle, you're going to find few of the low volatility stocks and few of the high volatility stocks. So it's a tough one. That's why today I'm just going to let the matrix tell me what to trade, okay, given the market condition, because I can't, if I am that picky in a way, then I'm going to have no trades. Okay, and again, I'm assuming no position in a portfolio, you're building something new, or your portfolio is neutral at the moment and you want to add something more, right? And add something more which is aligned with the current market condition. So today is a tough day. Last week was about the same as well, by the way. So what do we have? We have JD and Baidu. So I'll start with Baidu and see what is it that stock has to offer. So with Baidu, we have earnings that are being reported on 811. So we could use up to 805 for an iron condor. Okay, 805 for an iron condor. So the implied volatility is beyond one of the blue lines, but not beyond the other blue lines. So it's not like options are crazily inflated, but again, based on our methods and the matrix research, good enough. So let's take a look. How am I going to build the iron condor? Spread builder. So let's float it. We have Baidu. We are looking for a short iron condor. Okay. This is a stock trading at 140. So I'm going to be happy risking. Okay, wait a moment. Let me get the right expiration days to find the strikes available. We set up to August 5. Okay, so with those expiration dates, the minimum range is 1. And it's a 100 plus stock. You know what? I'm just going to go for 1 or 2. Okay, that's it. Great. So with that in place, let's activate my filters. Let's look for template iron condor preferred parameters, which again, this is me being picky. And now let's build 99 condors and sort to see if anything passes. So we got July 22nd passes, but I am really not happy to see bid 1 075, bid 1 075. Okay, some of them are better, but some of them are going to be very low quality. Okay, so let's take a look at the chart. So when looking at July 22nd, that's a 1 week expiration date, 1 week iron condor. We are looking at 157, 125. So 157. Do we have 157? No, we have 149. We have 149. And if I get to the 156, we're talking about August 5. Okay, so that would not work. So we move all the way to August 5. It seems that July 29 is not providing anything for us. So let's sort and let's reassess August 5. So the highest it go is 156, 161, maybe 161. Let's say August 5. August 5 is here. And it's 168. Okay, 168. The most we got is 161. Everything else now falls under fail. So we are not gonna go it. We're not gonna go for it. Baidu is not gonna be a valid candidate. The next one was JD. So let's take a look at JD. Let me double check. I think it was JD, right? Yes, JD. Okay. Okay. So this is a cheaper stock. Earnings are on 822, so we can go all the way to 819. Okay, 819. So let's take a look at all those various expiration dates. Okay, this is a $60+ stock, so we're gonna go for from 1 to 2. Same story. Actually, 1 to 1. That's good enough for a $60 stock. So let's build 99 iron condors. Sort them. And let's begin with July 22nd. Okay, we got returns on July 22nd, which may be valid. So let's take a look. So July 22nd shows us 67. Okay, 67. So let's take a look. Do we have 67? We got 66, 67 here. Okay, 67. So okay, so if we do 67, we do 67 and 54. Okay, so what do we have here? 67 and 54. So this may be valid. I'm gonna add it. 67 and 55, that's not good. And now we are moving into July 29. Okay, so we have a potential trade not confirmed yet, but we'll need to take a look. Now looking at July 29. Okay, sorting. Okay, so July 29. What's the minimum for July 29? I'm just gonna float this. So July 29 is right here. And we are talking about 70 and 51 plus. So do we have anything with 70, 65, 67, 68, 67, 69, 70 and 52? 52 is not good, it should be 51. 71, 53, 53 is not good, should be 51. 70, 49, and that is August 5. Okay, so the July 29 does not give us what we need, so we're gonna move to August 5, and we're gonna rebuild 99 trades. Okay, and let's begin with August 5 to see what August 5 has to offer. So August 5 is 72 and 49 plus. So we're looking at 72 and 49 plus. So this maybe. This price look okay. So let's graph it. 72 and 50 for a moment. Now I forgot what I said in the bottom part. 49.5. Okay, this is good. So 49.5. So 72, 14.5. This is 50. This is not good. So we keep going. 72, 51, 73, 51, 71, 52, 73.497. This is August 12. So these are the best prices we got on August 5. So we are now moving to August 12. Let's build 99, sort. Okay, with August 12. So we are talking about 73 plus and 48. So 73 plus and 48, that's not good. 75, that's good. That's not good. We need 48. 73.50. 74.50 something. 73.50. Yeah, and now we are dealing with August 19, which August 19 being the monthly, I would not be surprised that it's not going to work. And also notice how it's giving me price increments of $2.50. So it's going to be a different animal from a risk point of view. Let me see. So with August 19, we are dealing with 75 and 46 plus. So do we have 75? No. And we are now getting to fail. Okay, you can see how the monthly is less efficient. Okay, less efficient. Okay, so we got two possibilities for an iron condor on JD. Okay, so one would be this one, and the other one would be this one. Okay, those are the two trades that we have. So the one on the right utilizes July 22nd expiration. That's the one on the left, and the one on the right uses August 5 expiration. They both end up generating a credit similar of 22 cents. And they have different breakpoints, obviously, but they are sufficient for what we needed. Wait a moment. What is happening here with the break-even here being 54? 54. Was that good enough? 1 second, guys. So we got July 22nd. Yes, it's good. It's good. For whatever reason, I got confused. So anyway, yeah, so it's good. Those two trades are valid from that point of view. Now the question is, will we have UFOs to defend the trade? And also, most importantly, with the one that expires in 1 week, you also need to take into consideration your trade preferences, because normally with a trade that expires in a week, there is not too much you can do if the stock moves against you. Now, good news is that time decay should happen very quickly, and this is a trade that maybe on, again, depending on the rules that you apply, maybe on Monday, Tuesday, something like that, you can just get out of the trade and you have an okay profit and you're done. But if the stock moves against you, even butterflying it probably will not help too much. Okay, that's the problem. Where if you do August 5, you have more action that you could employ when it comes to helping the trade. Okay, so those are the pros and the cons to evaluate. Okay, now something I would like to do as well here, given the fact that the premiums that we get are very little and we have a little bit of time today, something I normally don't do, and normally I don't do it not because of nothing, just typically because of lack of time. But I would like to do it today. So I would like to explore a comparison where I'm going to compare these two trades, okay, with an iron butterfly, okay, especially for the one which is a 1 week only, which we know that butterflying may help. The question is, what if I butterfly it from the beginning? Okay, and then that's it. There's nothing else I have to do there. So look, we are looking at the put located at 54, and the call located at 68. So if we look at the midpoint between 68 and 54, the midpoint is 61. So if I was to sell two of the 61s, that now becomes an iron butterfly. You can see here it says iron butterfly. And the question is, what are my new break-even points? Okay, and it shows us 57 and 64. So yeah, so it's really not as advantageous as we would need, right? The break-even points are way, way, way narrower, way, way narrower. So that's not going to be good. That is not going to be good. Again, depending on price anomalies, sometimes in a case like this, it could be helpful, but in this case, it's not. Okay, so I'm going to do the same exercise with the other one. The one on the right, which is the one with August 5 expression, is using strikes all the way from 49 to 73. So if we look at the midpoint, it's 61 too. So if I do 61 and 61, okay, let me take a look at those break-even points. So those break-even points are a little better, but they're still very much within the purple lines. Okay, which the purple lines is a 1 standard deviation of price movement. So not good. Okay, not good. Not happy with the result of this potential idea. Okay, so now let's go ahead and take a look at the location of UFOs to see what is it that we are allowed to do, because here it's either we do July 22nd trade, or we do an August 5 trade. Okay, so it's either July 22nd, and some of you, by the way, may have a rule. I think we talked about this in prior sessions, where you don't allow yourself to do iron condors of 1 week because you cannot massage them, and then you may decide that as your trading plan that you're just not going to do it. If that's your case, well, obviously it's an easy decision. You would do August 5, but maybe it's not your case, and therefore maybe you have a different view. Okay, so we got 43% probability on the 55-minute time frame. So not happy about that. What about 89? Okay, just waiting for the time frame to load. 37%. That is really not good. What about 144? Not good. 233. It's probably not gonna look good, given the fact, yeah, not good. So then my only choice here is really going down the time frames. And if I'm gonna go down the time frames, then my preference is gonna be to utilize the 1 week. Okay, the 1 week iron condor. So if I go to 34, I got 45%. If I go to 21, I go to 48%. So that's good enough. I got my 48% or more. And now what I need to find is I need to find UFOs above and below those lines. Okay, so the nearest UFO I find here is located all the way here, which is very far. And the nearest UFO I find here is located here, which is way better. Okay, way, way better. So let me drop to the 13-minute time frame and see. Got 50%. Yes, this is good. I have a UFO here. Right here. This is much better. And this is probably pretty well balanced with the one I had below. Okay, more or less the same distance. So I'm okay with that. Okay, so if I go back to the daily time frame, you can see that I have a little bit of space between the red and the purple, a little bit of space between the red and the purple, and therefore this is my profit zone from here to here, from today until next Friday. Okay, so this is a 1 week iron condor. Okay, bad news, if it goes against us, there is very little we can do to help it. Good news, the time decay should happen extremely fast. Okay, so let's put the trade in. We're gonna do the 1 week. Okay, that is July 22nd. This is the condor that we're gonna do. This is gonna give you 22 cents. This is good because our minimum would be 15, right? Is 15% of the roll raise, which is 1, so that's 20 something. Of course, this is a type of trade that, and you see me talk about this in past sessions, this is a type of trade that I love for practice purposes because you can execute this in a real account and the risk of the trade is fairly limited. It's $78. Okay, so it's fairly limited. It's nice for practice. Of course, if you want to make real money with that, you're only gonna make $21 per contract. So that would force you to use many contracts. So that to me is not appealing. I'd rather use an underlying stock with a higher price point, so I can use less contracts and make more money for a similar type of risk. A bit greater, of course, more risk, more reward, but not that great. So I would prefer that approach. But for practice purposes, where your priority may be to keep the risk extremely low and execute a real trade and all of that, this could be a great candidate for practice. Again, that's obviously your decision. We don't do financial advice, as you know very well, but again, it's a consideration that for educational purposes could be useful. Okay, so let me do it. I'm going to get into TOS. We are looking at JD. We are looking at July 22nd expiration right here. And the strike we're going to be using is 68.67 on the call side. So 68.67 on the call side. And on the put side, we're using 55.54. 55.54. This is supposed to create a credit of 21. So I'm just going to send it and see if we get filled. Okay, 22.5, 23. I would say with a little bit of patience, we may get it. Okay, let's see if we do. Okay, in a real account, I think that with a little bit of patience, we may get it, or I would say 20 cents should be very doable. I saw the bid and the ask 32, 38, 43, 48, 33, 39. We got volume for all the strikes. Open interest is okay. I would say this is not a crazy thing to ask for. We should be able to get at least those 20 cents, I would say. If I don't get it, I'm going to push it because we are 3 minutes away from the end of the session. And of course, I want it. So I can talk about it in future sessions and help you understand the mechanics of trading and the trades. But anyway, I just got filled. I got filled 22. Thank you very much, Mr. Market. So let's go ahead and document this. So we're going to do fill priced, fill priced, fill priced, fill priced. And we'll start with a 67 call, 38 cents. 68 call, 27 cents. Then we got 46 and 35. Okay, we have it. Copy. And we're going to just add it to the positions panel. Under Twitter, this is our new trade for the day. And basically, the last thing I have is to draw a couple of lines on the chart so we can track this trade. But also, while I'm doing that and we are concluding the session, guys, how is it going? How is everything? Everything understood? You guys, let me know If it's not the case, or if you have questions, and also bonus question, since some of you are in the crypto course, and I haven't had really the time to chat with you because Boyan is conducting the course. How is it going? Out of curiosity, how is it going? Is it going well? Was it eye-opener? I'm pretty sure that watching the recordings will be very important because it's a lot of new terms in the digital assets space. But I'm very curious to hear how is it going on your end, my friends. Let me know. Take a sip of water, read you, and we'll call it a day. Okay. Thank you so much, guys. Cool. Okay, so we will call it a day. Thank you so much, as always, for joining me. Always a pleasure, my friends. We will talk very, very soon. And see you then. See you, I believe, actually, yeah, I am actually sure. I will see you on Sunday. We have a top session on Sunday. So see you then. Bye bye, everybody. Take care.